Welcome to Those Odd Numbers podcast. My name is Jason Snider. I'm the founder and CEO of Main Street Financial Group. We are your fractional finance team.
I'm Summer McFarlen. I'm a CPA and certified tax coach. I'm also the co-owner of Main Street Tax Group, where we do strategic tax planning so you can keep more of what you earn.
I am Masheka Turner, and I am the owner of Bright Skies Business Services. We are your outsourced accounting firm and profit first strategies. And we are here to help you create wealth through your business by gaining clarity around your numbers.
Hello and welcome to Those Odd Numbers. Today we're going to be talking something all three of us were having fun talking about earlier: inventory and product businesses, and how inside of Profit First, how we make it to work for those types of businesses and things. So I can start with, given that we have about a 40% customer mix inside of e-commerce. So this is a very relevant conversation that we're having on a regular basis with our clients of how do we manage and make the inventory system for Profit First work, because that's the number one killer of most e-commerce businesses is cash management of inventory replenishment. For those who are familiar with the Amazon ecosystem, Amazon penalizes you for missing certain inventory targets if you're out of stock and other things. So it can be a big detriment to an e-commerce business if you don't have inventory, but also on the conversely, you don't want too much either. And we were in our pre-production discussion, we were talking about I shared a story about that comes up a lot at the end of the year. Hey, Jason, you showing 68,000 in net income, but I only see 8,000 in my bank account. What gives? Where is it? And so go back and look at your shelf. Theoretically, because most of the time it's not sitting in their office or their home office, but go check out your shelf. That's where all that cash is. It's sitting on your shelf there. So,
Your warehouse.
In your warehouse and wherever it's located and things. So it's a big important thing, and to varying degrees, it's a big sunk cost, if you will, for a business. It's even if it's a small business, a small retail shop. I mean, can be thousands of, if not tens of thousands of dollars that's sitting on the shelf that's largely idle if it's not moving and things. So we're going to be having a good discussion today on inventory. So Masheka, Summer, how about your client discussions? How's it gone with product businesses?
So one of the things that I see a lot, so of course, I do self-pay medical providers. So that normally looks like med spas, weight loss clinics, self-pay providers. And so some of the things that I see a lot is not properly tracking inventory, but also just lumping in everything together. And this is what I mean by that. Of course, there is the product cost or the cost of goods, and there are the monthly bills that you have to pay every month. There is a reason why you would want to separate those things related to cost. Some of the things that I see a lot, I don't want to take this in a negative space, but I will. Particularly a lot of clinics, sometimes their products walk out the door. If you are lumping all of your costs or all of your expenses together and not really breaking it out, you can't get a good idea of what your gross profit is. Because, so let's just think about this. And I don't want to get too technical, but I just want to put it out there. So let's think about this. We have what we spend on products, but we also have what's on the books. If you can combine that, you can get an idea, okay, this is about what I should spend. If you look and you say, oh my goodness, where is my products? But your appointments don't match that, you can get an idea. There is a hole in the bucket somewhere. And as much as I hate to take the conversation there, this is a real conversation for this space. This is a very real conversation. I know it. I know it.
Oh, it's a good conversation. I mean, I never thought about that.
Yes.
So, but you've seen it working with the businesses that you work with. Yeah.
That's it. I mean, you think about it, you got the Botox injector and they're watching you do injections all day.
They're going to leave with an injector and some Botox?
That's it. And meet up in a hotel room over the weekend. But okay, I'm getting on topic. But anyway, but I say all of that to say, really look at alternatives. Some of the things that I've been seeing is some people are, instead of just buying a lot of product up front, they're matching it to their bookings. Some of them are even matching it up where they're getting the customer to buy some of it up front. So maybe you get a small discount if you buy vials up front. So just anything to take the cost off of you, because the inventory is nothing for it to get out of hand. Also, another reason why you really want to section it out to be able to tell what your cost is the price is often fluctuating. And I'm talking about from month to month, sometimes the price can fluctuate. And so if you don't have a good understanding of what percentage of revenue your products should be, then you can't even really tell, okay, what's my profit margin on this? So,
Masheka,
yes.
define profit margin. What is that?
Yes. Okay. So let me go into it. So there is the sales or revenue that you make for the service, and then there's the cost. So when I say cost of goods, I'm talking about injectables, any medicine, anything that you're using. Also, I want to include credit card and merchant fees as well. And so once you take the sales that you make and you take out those cost of goods, product costs, merchant fees, it says gross profit on
Very
your
good.
profit and loss. But that's what I mean when I say
Yeah,
that. So
that's
it
what
is
gross
very
profit is.
important to get an idea of gross profit. And we're going to talk about it a little later. But where the magic really happens is when you build your profit first around that gross profit. Because if you think about it, that product cost or cost of goods, that money is not really yours, because you have to spend that to provide the service. Or in e-commerce space, you have to spend that. So that gross profit, if you can get your arms around it, then that's when you can really create magic with profit first. I think I went too much into it, but I'll let you take it, Summer.
Oh, no, I think it was good. In our, like Jason said, we had a little conversation about this pre-production, and I'm a tax person. I don't really work with a lot of inventory, so I don't know a whole lot about it other than it's a big cost, right, for my clients. And I know different industries have different gross profit or what percentage of cost of goods sold should be your sales. It can vary by industry. So I don't know if there's a rule of thumb that we need to follow or not. I always think, well, if their cost of goods sold is 50% or less of their revenue, then I think we're doing okay. But how can we make that better, and what should their industry be at? So I kind of look at it from that perspective. Like I say, when I do a tax return, we do some tax planning. That inventory number comes from their system, or their cost of goods sold, it comes from their system. And hopefully they have a really good system in place, or something like that, where they're tracking that really well.
I'll add one thing to this that we end up having lots of discussions about is inventory counts. It always seems to fall to the sometimes like the second week of January, even though we've had the discussion since October. You need to at least do an inventory count once a year. And I would advocate, especially if there's a higher volume, doing it 3 times a year, to get better visibility. Because as you mentioned, Masheka, about product walking out the door, some of it's nefarious. There's shrinkage and other things. And if you run out of products, especially with our e-commerce or retail clients, if you don't have a product, you don't have a sale. That's the fuel that nothing happens without a product to sell in a retail or e-commerce business. And so if it's not there, you can't sell it. And if you're not aware that it's not there, then it creates another problem, because somebody who wanted to buy it can't now buy it, is going to go somewhere else because it's not there. And so I know it's a pain point for a lot of our clients of getting that conversation and getting it scheduled and getting it done. But it makes a huge difference. And also on the tax side, it's an important thing, because it's the cost of goods in your tax forms is calculated a lot differently than how we do it on the accounting side, which is purchases, beginning inventory, and then what's remaining. and that's your
Mhm.
cost of goods. It's a different
Mhm.
calculation
We
than
can throw a few, like we can throw some other costs in there, like your merchant fees and things like that. Um, on the tax return, I do, but you're right, it is different. And I was going to say, even here's a little tax tip, or if you make, I believe it's $25 million or less in revenue over the prior 3 years, you can actually expense all of your inventory for tax purposes. Now, you would not keep up with, I mean, that would be a book to tax adjustment, right? That's something that we would do when we were taking the return, but that is just a little regulation that's out there, a little rule that maybe helps the smaller business person.
Ooh, I love that. One thing I wanted to go back to with Jason was talking about on the inventory count or the inventory tracking. One thing I would recommend too, and like I say, it may be just because of the line of business that I'm working with or the industry I'm working with, is a segregation of duties. So if you are the injector, maybe you're not going to be the person doing the counting. Maybe it's going to be the front desk
Yeah.
person. Maybe it's going to be, but a segregation of duties because, again, I don't want to take it to a negative space. But since we are talking, a segregation of duties just gives you a little bit of cushion just to protect you more as a business owner.
Yeah. Yeah. I have someone else counting it that's not
yeah.
working with it. I think another thing that I did with a client once, they were in an industry that um, some product could off, but it was highly regulated. And so it was the cannabis industry, and that's highly regulated, and your stuff cannot go missing in that industry. Right. So what we would do is we had an outsourced accounting team, and we would have the outsourced people that weren't in the store every day or anything like that. They were overseas. We'd have them pull 10 SKUs for each store, um, a couple of times a week. And then the manager would go out and count those 10 SKUs. So that was one of the ways that we kind of controlled that.
That's a good thing about doing counts is if you have a lot of SKUs, cycle it. You don't need to
Cycling.
do, say, all 10,000 of them in one go. You could do, 2,500 if you're doing it quarterly, 3,000 if you're doing it every 3 or 4 months. You don't need to do it all at once, depending on your operational needs. But that way it keeps the burden a little bit less. It's less intense. And because I've seen it, retail shops sometimes will close for a day or two to do
Yeah.
inventory. And those are lost sales. Those are opportunities to sell. And that shows the importance of it from these larger companies of how important it is to maintain visibility on their inventory by scheduling us knowing that they're going to be losing sales when they close up for several hours to a day when they're doing their inventory counts and things.
Mm-hmm. You don't
Agree.
want to do anything that's going to halt the sales.
Absolutely.
And
Absolutely.
And we were talking earlier about, I think you mentioned as well, Masheka, how do we handle it in Profit First? For those who are familiar, read the book, there isn't really an account specifically for inventory and things. And so we were discussing earlier, we kind of have a similar method of how we approach it. And I'll start with how we do it in our e-commerce clients. Generally, if there's no inventory account when a client comes to us and we're implementing Profit First, as we are going to create a account inventory / cost of goods. We name it that depending on the business. So if it's a dropship model, which means they don't purchase the inventory up front, we term it a cost of goods account. And if it's Amazon seller or somebody else like that who needs to acquire the inventory before a sale, we'll term it inventory. And in the beginning, since we are just starting working with the client, we don't have a lot of data or feel for what the business operations are, is we do a 12-month look back. And then we calculate the aggregate spend over that 12 months for inventory purchases. And then we divide that, put that against the gross revenue, and that's our percentage of inventory. And so that gives us at least an initial start with so that we can get started. And then as we work together with the client, then we'll fine tune that and adjust it. But we need to get started with something. And that's our way of getting that process started so that we can arrive at the real revenue number and then base our other allocations based on that. So usually it ends up being a 3 to 6 month process to really get that fine tuned, because inventory cycles in, cycles out. There's purchasing cycles where it can be longer than 3 to 6 months. And so that's why working with a first professional, we can bring those experiences to more complicated business models and things. So I know, Masheka, you had some that you were sharing about some of your practices that you have with your clients as well.
Yes, so we do something very similar. So the first thing we want to do is, again, make sure that we're getting the proper cost of goods segregated, and we're using the gross profit, aka real revenue. That's how, and then we start our allocation from there. Usually, how we approach it is we normally put in 3 to 5% on top of the cost of goods, just to give the owner a cushion, and also just for price adjustments, inflation. And another thing that we do that really adds value for the clients is we look at those adjustments about every 90 days, just to make sure that those costs are still the same, because it may be where the beginning of the year, the cost is 25% of revenue. If there is an adjustment and a price hike, and say it goes to 32%, even though that's not a lot, that is a lot when you're really looking at that real revenue. So not only do we want to make sure that we have our cushion, but we want to make sure that we are looking at it regularly throughout the year, because that cost can be adjusting, and it makes a difference when you're setting up your profit first allocation.
Yeah, and I think that's important, especially with over the past more than a year, a little more than a year now, where tariffs have been coming into play for products and increasing the cost. And I know that's put a lot of pressure on a lot of.
Absolutely.
So yeah, looking at that every 90 days and adjusting accordingly, I think is a really good tip.
Yeah, and that also brings up what's the real cost of inventory. And this is a very common discussion, at least in the e-commerce space, of what's the landed cost is the term we use. And that is inclusive of tariffs in our view. So anything it takes to get that product into a sellable position is, we want to include that in the inventory cost. And there's different ways to account for it. Some of it's direct in the sense of, you pay the tariff. Am I going to go back and try to add that to every SKU item that I purchase? No, but I'm going to put it in a cost of goods account, landed cost or tariffs or something like that, to recognize what the cost is. But in our profit first cash management, it's going to be part of our inventory cost of goods account. So it's all bundled together. It's inclusive of all those spends. That's why we bundle that together, because we want to include that. It's going to come from that account. And so we're going to allocate funds for that using the process I mentioned earlier from that account.
Yes, that's a great point.
Mm-hmm.
So you guys have anything else that you want to add to our inventory discussions? And also feel free to, send us any questions that you have if you want us to, answer it on a deeper level.
Yeah, this could go for multiple episodes, I think.
Absolutely, it really could.
We're just painting a light picture, and maybe there'll likely be future more in-depth discussions, especially as guests join from their different business perspectives and things. But yeah, I think this paints enough of a picture to show that we do have systems in place that work with a profit first professional, because we'll be able to work with your business and get it fit so that it's while the system is great for, you could just take it out of the box, there's things that you may want to have in your business that you want to be able to manage better. And so work with a profit first professional to get those things pointed in the right direction for your business.
Mm-hmm.
Yep, I like it.
See. So do we have any tips that we want to share since we're coming to the end of this episode? My tip for this one episode is work with a profit first professional. For those who are listening, even if you're not going to seek out an engagement to work on a regular basis, many of them offer a discovery call or something like that where you can ask questions, especially somebody who's knowledgeable in your particular industry or niche. There's a few of us, I think like 7 or 8 that I'm aware of, that have heavy concentration or focus only on e-commerce. and we've built systems that have a lot of experience in those things. And so even if you may think your business isn't covered by the book or one of the derivative books, reach out to Prop First professionals or find one locally and see that might be able to help work with you and your business. There's likely somebody who can help you.
That's a great tip. I think my tip is it's not one and done. So once you set up that cost, make sure that you are looking at it regularly to make sure that you are always adjusting accordingly to get the most out of it with the Profit First system.
That's a good tip. Like I said, I don't work with a whole lot of inventories. So my tip is going to be listen to Jason and Masheka because they know what they're talking about.
I won't add to the self-motivation there.
Sorry, that's all I could come up with.
No, that's good.
All right. Right. Thanks, everybody. And we'll see you on the next episode.
Bye.
This content is for general informational purposes only and is based on current law and guidance as of the date of recording. Tax law and regulations are subject to change. This discussion should not be considered tax, legal, or investment advice. Listeners should consult their own tax or financial professional regarding their specific situation.